Every time you wake up in the morning and head out for a cup of coffee while keeping up with the latest headlines, do you wonder what life will be like after you retire? Well, many folks may be unaware of the enormous influence retirement planning may have on one's long-term objectives. Greetings to all of you! Financial and Investment Wisdom is back with more financial advice. In today's episode, we will cover the 5 important steps of how you will plan for your retirement. But first, make sure you click the like and subscribe buttons on our channel. Retirement planning identifies retirement income objectives, as well as the actions and decisions that will be required to accomplish those objectives. It is necessary to plan for retirement by identifying income sources, estimating spending, developing a savings plan, and managing assets and risk. To determine whether the retirement income objective will be met, projected cash flows must be estimated. Investing in one's future is a multi-phase process that develops with time. For a happy, secure, and enjoyable retirement, you must first acquire the cash reserve to provide the necessary funds. Retirement planning begins with considering your retiring objectives and the time frame within which you must achieve them. Then it would be best to investigate the various sorts of retirement accounts that can assist you in raising funds needed to finance your future. As you accumulate savings, you must put that money to work for it to grow. To assist you with your retirement planning, here's the 5-step retirement planning guide. First, you need to understand your timeline. A successful retirement strategy begins with a thorough understanding of your current age and anticipated retirement age. The greater the amount of time that elapses between today and retirement, the greater the amount of risk that your portfolio can endure. Generally, your portfolio should be geared more toward generating income and preserving your wealth as you get older. A large percentage of your resources should be in higher risk investments, such as stocks if you are younger and have more than 30 years to retiring. There will be volatility, but traditionally, equities have surpassed other assets, such as bonds, over lengthy periods. Additionally, you must earn returns that outpace inflation to keep your purchasing power during retirement intact. In addition, you should divide your retirement plan into several different components. To find the appropriate allocation system for a multi-stage retirement savings plan, you must take into account various timeframes and the related liquidity requirements. Rebalancing your portfolio should be done regularly to keep it in line with your changing investment objectives. After understanding your time horizon, you must determine your retirement spending needs. Being accurate about your post-retirement purchasing behavior can assist you in determining how expensive your retirement portfolio should be. The majority of respondents expect that their total spending will amount to only 70% to 80% of what they spent previously when they retire in the future. It is common for such an assumption to be proved false, particularly if the mortgage has not been paid off or unexpected medical bills arise. The first few years of retirement are often spent spending on vacation or other bucket list pursuits for retirees. Given that retirees no longer need to work for 8 or more hours a day, they have more time to travel, see the sights, shop, and participate in other costly hobbies. Correct retirement spending goals aid in strategic planning because increased expenditure in the future necessitated the accumulation of extra assets today. In retirement, getting an accurate forecast of your spending is critical, says Kevin Michaels, a financial advisor. Take, for example, the possibility that you will want more money than anticipated if you wish to purchase a home or pay for your children's education after retirement. Those expenditures must be taken into consideration while developing a retirement strategy. Remember to revise your plan at least once a year to ensure that you are on course with your financial goals. This is crucial as it will influence how much you withdraw each year and manage your account. It is possible to outlive your portfolio if you overlook your needs. Still, it is also possible to exaggerate your spending and risk not living the type of retirement lifestyle you desire. Hey there folks! How is the video going so far? Like and share this video to spread the word about retirement planning. Once the anticipated time periods and expenditure requirements have been identified, the real after-tax rate of return must be computed. This is necessary to determine whether the portfolio will be able to generate the required income. Even for lengthy investing, a needed rate of return in excess of 10% before taxes is generally considered to be an impossible standard. Since low-risk retirement portfolios primarily comprise low-yielding debt assets, the returns level becomes lower as you become older. Suppose a person has a retirement fund worth $400,000 and has $50,000 worth of financial needs. Provided no taxes are paid and the portfolio balance is not reduced, this individual is reliant on an unreasonable 12.5% return to get by. The significant benefit of starting to retire comfortably at a young age is that the portfolio can be developed to ensure a reasonable rate of return in retirement. Investment returns are ordinarily subject to taxation, depending upon the type of retirement plan that you have in place. It is, therefore, necessary to compute the exact rate of return after deducting taxes and fees. When it comes to saving for retirement, understanding your tax position when you begin to withdraw funds is a critical step in the procedure. Next step is for you to assess your risk tolerance. Risk tolerance refers to how much of a deficit you are willing to accept in your investment portfolio. Your risk tolerance is determined by a variety of criteria, including your financial objectives, income, and age. Choosing an appropriate asset allocation strategy that integrates concerns about risk aversion and yield targets is likely the most critical stage in retirement planning. You must ensure that you are comfortable with the risks that are being incurred in your portfolio and that you understand the difference between what is essential and what is a luxury. When the various mutual funds in your portfolio have a terrible year, you should add extra money to them to compensate for lost time. Do not give up on the mutual fund that has been underperforming this year. It may turn out to be the most excellent performing next year. Lastly, another vital element in creating a well-rounded retirement plan is estate planning. In estate planning, each part necessitates the involvement of different professionals, such as lawyers and accountants, who are experts in their respective fields. Additionally, insurance coverage is a critical component of both an estate plan and the retirement planning process. It is essential to have a good estate plan in place, as well as adequate life insurance coverage to guarantee that your assets are dispersed in the way of your desire, and that your family members do not suffer financial difficulties after your death. A well-thought-out plan can also help you avoid the costly and time-consuming or frequently prolonged probate process. In addition to estate preparation, tax planning plays an essential role in the overall process. If a person chooses to leave possessions to family members or a charitable organization, the tax effects of donating versus passing assets through the estate process must be considered in context. Common retirement plan investment approaches are centered on delivering sufficient returns to cover annual inflation-adjusted living expenses while also maintaining the value of the fund's principal investment. After then, the portfolio is transferred to the beneficiaries of the deceased person. You should also consult with a tax advisor to find the most appropriate plan for the particular individual. Overall, individuals are shouldering a more significant share of the responsibility for retirement planning now than ever before. Only a tiny percentage of employees may rely on an employer-sponsored defined benefit pension plan, particularly in the private sector. The transitions from defined benefit pensions to defined contribution plans also implies that you will be responsible for handling your assets rather than your employer. One of the most challenging components of developing a thorough retirement plan is finding a balance between reasonable return expectations and the style of life that the retiree wants to maintain. Alternatively, concentrate on developing a flexible portfolio that can be modified regularly to reflect changing market conditions and long-term financial goals. Are you now ready to plan for your retirement? Let us know what your thoughts and opinions about today's video are in the comment section. For more helpful financial advice, check out our YouTube channel, and if you enjoyed the video, please do not forget to like and share. This is Financial and Investment Wisdom, and we will see you again next time.